Today I'm going to run through 5 stocks I've been buying heavy over the past few months, and then I'll continue to buy heavy over the next few months. All 5 of these stocks have tremendous growth profiles and tons of positive catalysts that are going to allow them to continue to strengthen their underlying fundamentals, and as a result, that's going to lead to major share price appreciation over the coming years. These stocks today span from AI to advertising to telehealth to fintech. So we've got tons of different types of stocks in here. I'm excited to get into this video, but first, if you're new here, welcome. If you're not subscribed already, click that subscribe button and help us get to our short-term goal of 10,000 subscribers on this channel. And if you want to hear about any other stocks I'm buying, selling, holding, any research work I'm doing, consider checking out the Patreon with the pinned comment or the first link in the description. All right, let's jump into the video. The first stock up here is an AI stock, and specifically it's an AI hardware stock. And this is AMD. This is a $238 billion market cap, and the stock is just now starting its reversal from the downward trend that we saw for multiple years. But if you were buying in that major crash in April of 2025, you would be up over 87% on your shares in just a few months. AMD's got tremendous momentum behind it right now, and it's bucking the trend of the market. Over the past 5 trading days as of recording this video, most of the major indexes are actually down a little bit, but AMD is bucking that trend, and it's actually up over 7% just in the past 5 trading days. It's up 21% in the past month, and about 25% in the past 6 months, and like we said, over 87% from the April lows when we got that quick April flash crash. My average cost per share on AMD is $100.38, which means we're already up 46%, and I just started buying the stock a few months ago. And even though I'm already up over 46% on the stock, I'm still acquiring new shares for 2 reasons. One, I think we have a lot more to run from here, and we're just getting started with AMD, and I'll talk about that here in a sec. And 2, I'm not quite at my share allocation goal of roughly 5% cost in my entire portfolio. One of the main things from a financial standpoint about AMD that gets me really excited is that they're expanding margins very impressively each and every quarter. Check out their gross margin, their operating margin, and their net margin. Gross margin is up from 47.6 up to 48.3 up to 49.3 and up to 50% gross margin just in the past 4 quarters. Over that same span, operating margin went from a low 3.74 all the way to 5.64, 7.37, and then 9.62. Net margin 5.82, 7.52, dropped a little bit down to 6.36, and then rose again to 8% net margin. The margin expansion story with AMD is just getting started, especially with all the innovations they've announced. They're innovating on the gaming side, they're innovating on the consumer AI side, and they're innovating on the commercial AI side. Just in Q2 alone, they've announced multiple new products: the Radeon RX 9060 XT in their gaming segment, the Threadripper 9000, and the Radeon AI Pro R9700, focused on improving desktop performance and allowing for local AI processing. And on the commercial side, also in Q2, they announced the MI350, which offers a 35x increase in inference performance compared to the MI300 series. They also debuted their new AI cloud service, and they confirmed that the next-gen MI400 series is going to be released in 2026. The catalysts with AMD are absolutely ridiculous. We're seeing the same type of innovation we saw about 18 months ago with NVIDIA, and now it's AMD's turn. Are we going to get the same ripper rally like we got with AMD? That depends on what the sales numbers do, what the growth rates do, what the gross margins do. We're talking 100% revenue growth. We're talking 200 or 300% EPS growth multiple quarters in a row. It's possible for AMD. More realistically, we're looking somewhere between 25 and 35% revenue growth for the next few years, and roughly 70 to 100% EPS growth. Those numbers are still eye-popping. That is still going to lead to absolutely insane stock price growth, and I could see us hitting somewhere between 180 a share and 220 a share over the next 12 to 18 months. With expanding margins and those type of innovations and those type of growth rates, for us to be getting the stock at a 37 forward PE for fiscal 25 and a 25 forward PE for fiscal 26, this stock is still a steal deal, even though it's up 80+% from the lows in April. Second stock up on today's list is Hims & Hers Health, and this is ticker HIMS. This is a market cap much smaller than AMD. AMD at $11 billion. And although HIMS has had a great past year, up over 130%, and great performance year to date, up over 90%, there was some big time drama that played out with HIMS. They had a deal with Novo Nordisk, the maker of Wegovy, where HIMS was able to offer the name brand Wegovy direct to consumers on the HIMS platform. That partnership fell apart in like the snap of a fingers just a few weeks after it started, and when that news broke, the stock dropped by more than 34%, and from the peak before that news came out all the way until today, we're still down 24%. My cost per share was in the teens with HIMS for a long time, but since I've continued to buy more and more, even though the stock price is moving up, my cost per share is now $24.76, which means as of recording this video, we're up almost 97% on the stock, even though we've had that drama play out with Novo Nordisk. There were some pretty serious allegations that Novo Nordisk made that would definitely have legal ramifications if HIMS is found guilty of doing those things. But to me, HIMS is a whole lot more than a Wegovy subscription, okay? It doesn't make a big difference to me whether or not they're offering Wegovy on their platform or not, okay? I'm in it for all the other things. They have so many other great things going for them in their weight loss category, in their hair loss category, in their skin category, in their sexual health category, and they're continuing to expand their business. They'll be rolling out HRT later this year. They'll be rolling out a longevity segment. The organic growth potential with HIMS is absolutely ridiculous, even when you take Wegovy out of the picture and there's no Novo Nordisk partnership anymore. Also, they just acquired Zava, a telehealth company in the EU, so they're now expanding their footprint outside of the US. They're growing at ridiculous clips with one of the best growth profiles in the entire stock market, up over 100% revenue growth in their most recent quarter, more than a 5x in operating income year over year in the most recent quarter, more than a 4x in net income year over year in the most recent quarter. The growth profile is ridiculous. We know that stocks follow earnings over the long term. Not only does HIMS have impressive short-term earnings growth, but they also have very impressive long-term earnings growth outlook. They put out public targets for 2030, and in 2030, they expect at least $6.5 billion of revenue and $1.3 billion of adjusted EBITDA. That's more than a 3x in revenue from now until 2030, and more than a 7x in adjusted EBITDA from now until 2030. We're getting this stock at a 72 forward PE for fiscal 25 and a 50 forward PE for fiscal 26. Although those price to earnings ratios are elevated, they're much more than the average stock in the S&P 500, for example. Obviously, the growth is way more than the average stock in the S&P 500. The growth profile and the industry absolutely dictate where the multiples are going to go. HIMS is going to continue to command a heavy premium over the market if their growth rates stay how I think they will. You can't expect this stock to be trading at like a 25 or a 30 PE. Getting it to those levels is extremely improbable. All right, the next stock up here is Alphabet, and this is the parent company of Google. They also own YouTube. We all know about Google, one of the biggest companies in the world. This is a $2.2 trillion market cap. They recently started paying a dividend about a year ago, so I'm also getting some dividend money, but really this is a pure valuation play. Google's average PE over the last 10 years is about a 28, and the current price to earnings ratio is below a 20, which is about a 30% discount in comparison to the last 10 years average. They're also highly undervalued in comparison to their peers, specifically Apple and Microsoft, with better growth rates, comparable revenue growth, and way better earnings growth. And margins are expanding more rapidly for Google than their peers. This, along with the fact that the AI fear around Google getting replaced by ChatGPT is pretty much dead. It's not all the way dead, but it's dying each and every quarter as Google continues to innovate on the AI front. They've got their AI overviews. They've got Gemini that they keep improving upon and keep on stealing market share from someone like ChatGPT. Google Search, YouTube, and Google Network are growing very respectably, still in double-digit range, up over 10%, 3% operating margin expansion year over year for an established tech company like this. That is extremely, extremely impressive. Even more impressive is Google Cloud growth. Revenue growth for Google Cloud is about 28%, very respectable, and they had well over 100% growth in operating income, which made the operating margin for the segment explode from 9.4% all the way to 17.8% in a one-year span. The margin story is just getting started with Google Cloud. They're going to continue to grow in the mid to high 20% ranges as it relates to revenue for the segment, and economies of scale is just going to keep on allowing them to become more and even more profitable in that segment, and we're going to see crazy margin expansion continue with Google Cloud. For me to be able to pick up Google at roughly 20 times trailing earnings and 18 times forward earnings is an absolute steal. It's trading at a cheaper PEG ratio and cheaper PEs than the average S&P 500 stock, with way more growth, much quicker margin expansion, and a way stronger moat than almost every stock in the entire world, honestly. The next stock up here is The Trade Desk. This is ticker TTD. This is a $37 billion market cap, and the stock price has had quite a lot of trouble year to date so far. They had a rare miss in their Q4 earnings report, and they forecasted very weak guidance, and the stock dropped 33% in a single day, but the pain didn't stop there. Over the next few months, the stock trended down and down and down, hitting a low of $45 in the April flash crash, which was down more than 60% from the peak. The Trade Desk runs an ad platform that's one of the best you're going to find out there. This is one of the strongest companies in the CTV and the OTT space in advertising, with a best of breed product demonstrated by their customer retention count. They've had over a 95% customer retention rate for 11 years straight. This is an extremely sticky product, and the reason it's a sticky product is because it's an amazing product. Companies who use the Trade Desk to manage their advertising are getting an amazing ROI on that, and that is the Trade Desk's goal, is to increase their customers' ROI on their ad spend. A B2B software company like the Trade Desk that's growing revenues at more than 20% and growing earnings more than double that, north of 40%, is always going to command a premium valuation, but Trade Desk takes it to another level. The average PE for the Trade Desk over the last 9 years is 163, with the current PE, these are GAAP numbers by the way, of 92.59, which is 43% below their historical average. The reason the GAAP PEs are this high is because of their insane stock-based compensation numbers. In Q1 of 2025, they had $128 million of stock-based compensation expense, and that's in comparison to roughly $600 million of revenue. That's extremely high, and it makes the GAAP net income numbers way worse than the non-GAAP net income numbers. The SBC, the stock-based compensation, is not going to slow down for Trade Desk, it looks like. This is a low number, 128 million. I saw up as high as 200 million when I was doing research on the company before I bought it, but I bought the stock in spite of this. I look at the non-GAAP PE numbers for Trade Desk. This is very rare for me. The non-GAAP PE for 2024 was 46. For fiscal 25, it's about 43. For fiscal 26, it's about 36. They've also got a buyback program of up to $1 billion, and that buyback is offsetting the stock-based compensation in a major way. Normally, when we see big-time stock-based compensation, the worry with that is that it's very dilutive. It's diluting shareholder equity, which means it's going to hurt your overall total return, but they're offsetting that with their share buybacks in a major way, to the point where from 2021 all the way until today, there's been less than a 1% increase in shares outstanding. So even though the stock-based compensation numbers are high, it is not hurting overall shareholder return in the way that it's dilutive. It is not dilutive because they're offsetting it with those share buybacks. We're trading much lower than the average of all the stocks in the S&P 500 on a PEG ratio. The PEG ratio for the Trade Desk is actually below 1. It's at a 0.9 as of recording this video on a trailing basis. And that's compared to the S&P 500 PEG ratio of 1.45. So that's a more than 40% discount we're getting on the Trade Desk in comparison to the average stock in the S&P 500. And probably the biggest catalyst of all for the Trade Desk relating to their stock price is S&P 500 inclusion is likely coming within the next 4 quarters. It's actually surprising to me that the Trade Desk isn't in the S&P 500 already. They meet every single criteria. The market cap's big enough, the liquidity's there, the earnings is there. Everything is ready for them to get that S&P 500 inclusion. We know that that adds a lot of validity to a name like Trade Desk and puts more visibility on the stock to continue to increase the shareholder base. Now, the last stock up is a fintech stock, and this is Nubank. This is ticker NU. We're trading at some of the most attractive PEs we've ever seen for Nubank. The average PE over the last 3 years with Nubank was 86.5. Current PE is about a 29, which is 67% lower than the historical average since the company went public. Nubank is one of the main ways I'm getting exposure to developing markets in my portfolio. Their main markets are Brazil, of which they have 59% of the adult population as Nubank members. Mexico, which they have 12% of the adult population as members, and Colombia, where they have 8% of the adult population as members. They've got revenue growth of more than 40%, and believe it or not, that's actually somewhat of a low number for Nubank over the past few years. They've got earnings growth, specifically net income, of 74% year over year. They've got member growth of 19% year over year. They've got deposit growth of 48% year over year. We're trading at a 29 trailing PE and a 24 forward PE with a PEG ratio of less than 0.5. By the way, anything less than 1 is considered to be undervalued. But if we look at the 2-year forward PE, they're trading at 18 times 2026 earnings. The biggest upcoming catalyst with Nubank is that they're going to be rolling out a new market, and they'll be announcing that in the back half of 2025. I expect that either in the Q2 earnings report or in the Q3 earnings report. I can't wait to see that. Any new market they enter is going to be an absolute growth beast for the company. They've hit such a high number of adult customers in Brazil. They've got that very stable customer base up top with the Brazil numbers. And then they've got 2 other markets, Mexico and Colombia, where they've got insane growth, and they're about to add a third. The growth rate acceleration is going to be ridiculous, and I can't wait to see what the stock price does as a result. Let me know in the comments below what you think about these 5 stocks and whether or not you hold any of them. Definitely one of my favorite parts of posting here on YouTube is having some conversation with you guys down there. If you made it this far in the video, consider checking out the Patreon with the pinned comment down there or the first link in the description. I appreciate you being here in a major way. Thank you so much. Have a great day.